Hello and welcome. I want to welcome you to the AI Wealth Creation Traders Report. This is the guidelines portion of this. So if you're watching this, you likely just subscribed. Very much appreciate you being part of this. We'll be together for the next year. And these guidelines are there really to walk you through what the AI Wealth Creation Traders Report is about. And then I'm going to go into specific ways to basically, ideally, assist you in using the report, guidelines for your own trading, and if there's any enhancements or anything that I'm doing along the way, because I very much view the report as also an educational report. I'll continue to update the guidelines and I'll send them out to you. But this is what this is where we stand here today, and again, very excited to have you here. So again, welcome to everyone. Real quickly, by way of background here, you'll see simulated test results. It's not based upon actual returns. There's no guarantees if any returns in the future. By taking the service, you understand that there's a high degree of risk in trading. It's even greater when it comes into the leveraged ETFs, the single stock leveraged ETFs and the ETFs. Options trading has even additional risks that are involved in there, and very much just want to make sure that you understand, of course, to check with your advisor and anyone that is assisting you with this to make sure that all this is in line with what you're looking to accomplish. So let me jump right into this. And I have 14 guidelines here to be able to assist you, and we'll take one at a time. So what we want to do here is do as Stanley hedge fund legend Stanley Druckenmiller has done, is basically not look at where the AI prices or where the company's prices are today, or where AI is today. But what we want to do is imagine what the world is going to look like, not today, but 18 to 24 months from now. And when I'm making suggestions there on a weekly basis, so we start with the core portfolio that's there, both in stocks and ETFs, and the options that basically is done, at least from where I'm looking at is where I'm looking out, where AI can potentially be 18 to 24 months from now. I'm certainly cognizant where prices are today, and that does play some role in it. But when you get into a revolutionary technology, and I've seen this now for multiple decades, demand, because it's first time, demand just keeps coming in and coming in, and meaning as customers come in, as companies come in and apply it, this becomes demand driven. And as the demand becomes greater, especially over a 1.5 and 2 year period of time, ideally, these companies that we have in the portfolio participate and become the big winners in that. So again, if you can get away, and I'm going to talk about this when we get into the psychology section. If we just focus on the fact that it's good, try to imagine where AI is going to be 18 to 24 months from now. This is what I'm looking at when I'm making the suggestions within the report itself. Okay. Number two, the AI Wealth Creation Traders Report is obviously concentrated in AI industries and companies. Okay. It very much is your personal decision what portion of your overall money you want allocated to AI. Okay. We know that with these stocks, they can tend to be extremely volatile. That doesn't even account for the volatility that may or may not come into the marketplace as a whole at any given time. What we want to do, though, is what we want to let these companies just basically do their thing as AI continues to expand itself out. Ideally, they participated, they were able to gain continued competitive advantages, and their stock prices ultimately, the goal is for them to be significantly higher. No guarantees that they will be, but again, as demand comes in, as their revenues grow, as their earnings grow, ideally this stock comes along with it. What portion of that money that you decide to allocate to AI, again, is very much is a personal decision, and you know what's best for you. Because there's so many companies that are directly in AI or that are supplying AI or are in the midst of being beneficiaries of AI, there's no way possible to list every company that you can trade and invest in. What we want to do is we want to be selective all the way through. And as you've seen from the report that you just received for this week, you see that IM Selective is concentrated there. And we want to be diversified within the multiple aspects, the multiple industries that AI will touch as a whole. Okay. And this next point is important because just because I don't mention a company, it doesn't mean that I don't like the company. Okay, so it may be read. I've already received emails where some people have said, "Well, what about this company? What about that company?" And they're really good companies. It's a matter though of keeping the AI Wealth Creation Traders Report concentrated on the companies and on the stocks that I know and I'm comfortable suggesting for trading. Other companies, if you come across in your own and you're comfortable with it, of course, this is your decision whether to take any suggestions from the report, and also if you want to add any other additional positions that are there. So again, the main point I want to make is just because I don't mention a company, it doesn't mean that that's not a good company. It is something that potentially could be, and you can go further with it. Okay. Number 3, on the option side, we're using in most scenarios, we're going to be using options that go out a minimum of a handful of months to as long as a couple of years out. The ones that have options that might go out 1 year or two years out. Some of them trade pretty thinly over there. There's not a lot of liquidity, especially when you get into the long dated options that are there. And what I don't want to see happen, what I don't want to see happen is if I put a name on a list, and let's say I suggest an option that might go on 1.5 years or 2 years, that everybody's putting it in there at the same time. Because what market makers are going to do is they're going to just juice up the prices there. They're going to step in front of all the size that's there. And there are a lot of subscribers to the service. What I want to make sure is that, again, thinking out 18 to 24 months, there's usually not a sense of urgency to get into these positions immediately. You want to be able to work the orders by working the orders and saying, okay, can I get a price in here that basically is in line? Okay, I do take into account things like implied volatility and other factors that are in there. But what I'll do is often suggest multiple time frames, and especially multiple strike prices that can be used. And again, as the report gets larger and larger and larger, it's real important to be able to have multiple dates that are there to allow you to potentially get filled. The overall goal is to be there. That's the main thing there, is to be there if and when the stock has a large move. So work your orders and just know that if I'm putting something on the list for the first time, it's not off of the timing mechanism that's there. It really is that I'm looking out 18 to 24 months and saying, they're in the right place at the right time, or the right industry. Their stock is performing a certain way that on a longer term basis begins giving gives the impetus for me to move ahead and suggest this stock that's there. Also, as the report does continue to get larger and larger, I will do my best to basically give guidelines and assist, give guidelines as to how to get better fills, or how to get fills on these positions. Again, main thing though, you want to, ideally want to be there with these stocks. Number 4, this is for those of you who are trading options. Okay, I've been trading options for now, I guess, literally it's been over 4 decades. And what I've seen outside, I've worked with a number of traders out there on the options. I have a number of people that I've worked with that are professional options traders. I also have friends who are professional options traders that are there. The one mistake that I see, let's call it retail traders, or traders that really don't really understand, what option trades is. What they'll do is basically predetermine in their mind, well, I'm going to buy 5 options, or I'm going to buy 10 options, or I'm going to buy 20 options. Okay, that's not a good way to go about doing it. Better way to be able to do that is predetermine the dollar amount you want allocated per position. Okay, and what I do is I basically state that as 1 unit. Okay, so I'm going to give you a hypothetical example. And just to keep the math easy, I'm going to say there's a hypothetical $100,000 account. You're going to decide, you know what, I'm going to risk 2% per position. Well, 2% is $2,000. What happens over there in something like that is that's 1 unit. And every option position, ideally, every option position that you take will come in somewhere around that $2,000 number, okay? If I'm suggesting a half a unit, and I'm going to get into that in a couple of minutes, that would be $1,000. If trading $1 million account, 2% would be $20,000 for a full unit, $10,000 for a half unit. But again, what we want to do is basically look at these positions where we're risking 1 unit with the goal and the mind frame of making many times that. I'm going to talk about this in a couple of minutes as known as asymmetrical trading. But keep a fixed risk number at the best you can, because we never know which of these companies are going to have runs, large runs. And ideally, by having a fixed position size in them, the ones that do have runs in place, it pretty much assures that you're not going to be to have too small a position, and you really don't want to have too small of a position and then see a stock just run, and it just doesn't really make a difference. That unit size really does matter. On the other side of this, from a risk protection basis, unless you've made the decision to over concentrate on any one position, okay, it just understand that with the over concentration, if you're right, you're going to make substantially more money. If the stock moves in the opposite direction, you'll lose more money. So, balance that out. But this is very much up to yourself. My suggestion, though, is keep your dollar cost on the positions, keep them the same. And that would be a percentage of your overall portfolio. Number 5, tying this into asymmetric trading. The goal for the majority of the long option positions is to risk 1 unit to make many units there. Okay, it's putting up a fixed dollar amount to make many units. And this is at the heart of asymmetrical trading, where you're risking 1 unit to make many times your risk. This is not, this is not looking to basically buy an option hypothetically at 3, and we're going to sell it out at 4. We're looking at things that are going to go up many months, and in some cases that are going to go up many years. The goal is to make many times the units. There are going to be a number of losing trades here along the way. That's the way this works. Companies will end up missing on earnings. Markets could end up going down. There could be just time decay that will come in. But when you're wrong, you'll only have lost 1 unit. When you're right, and the stock has a good run, and ideally you'd like to be there for as it's running. That's the opportunity to make many times. When you make 3 times, 5 times, 10 times, could be 20, 30, 50, could even be 100 times if you're really fortunate and get in the company at the right time, at the right price. So that's the goal of asymmetrical trading. That is how the entire venture capital industry has been built over multiple decades. It's known also as the power law. What we're looking to do is risk 1 unit to make many units. And I bolded this intentionally. If you want to gain further expertise on asymmetrical investing, please read the book, The Down Dough Investor. Okay, it is one of the very few investment books I'd classify as life-changing. And there's very few that ever classify as life-changing. They may be changing within the investment side of the world, but this is life-changing in all aspects of business. A tremendous book. It has been recommended by Warren Buffett, Charlie Munger. I mean, there's a number of great investors out there, and Mohnish Pabrai is a multi-billionaire. Has become a multi-billionaire. Just a phenomenal individual to learn from. This book is strongly recommended to further your expertise on asymmetrical investing. And you'll hear me refer back to this book over time. I'll keep coming back to this book over time. It's worth reading and rereading many times over. Okay. After reading the book, and do start with the book first, if you want to go further applying the concepts from the book to your trading, take my course, Asymmetrical Trading for Wealth Creation. We expand it out. It's also a number of trading strategies that are included in there. They tend to be shorter term trading strategies that are included in there. But the whole goal is very much to find trading opportunities where we're risking one unit to make many times that amount. If you're interested in that course, please send an email to this address here. It's aitrading@tradingmarkets.com, and we'll send you the details of the course. Okay. Let's talk about hedging now. This is number 6 of the 14 that we're going to cover. So hedging your portfolio of the AI positions, it can be done a number of ways. Number one, you may say to yourself, you know what, I don't want to hedge this out. I've taken a portion of my money, I've allocated to AI. I don't need a hedge. That's in place. That's fine. That really is a personal decision. For those of you who want to hedge, these are 2 of my favorite ways. There's multiple ways to do it, but these are 2 of my favorite ways to do it. Number one is to short SMH, which is a semiconductor ETF, or if you want to be more aggressive about it, go long SOXS, which is the 3x short semi ETFs. Just know that a 3x is going to have all sorts of, it's 3x to the day. So there's mathematics that come in when they do the rebalancing on a daily basis. But that's really there to offset your long semiconductor positions. And especially when we're looking at the core positions within the AI industry, obviously semiconductors are at the heart of it. So that's a way to do it. Each of these also have options. Each of these also have options in place. The one thing about the options is that if the semiconductors go on a run, ideally the companies that you're holding are doing quite well, but those options could end up being way out of the money because the semiconductors moved up pretty quickly, or SOXX, could have dropped pretty significantly. So just keep an idea in there that time is going to play a role. Doing the outright to be able to short SMH or going long SOXX, ways to be able to do it. B is something that you have likely never seen before, and I covered it in the very first trading lesson when we launched the course, and we're going to make that available. This is something that very few people know about that's out there. So there is an ETF known as the Innovator IBD 50 ETF. It basically is the IBD 50 list that's there. It's been out since 2015, and is one of the best kept secrets out there, that this is a great way to hedge, at least in my opinion, a great way to hedge long exposure in the marketplace because of its 10-year performance, or I should say lack of performance, which I'll share with you in a couple of minutes here. So IBD 50 list, it has been a horrible performer for years and even for decades. And the IBD 50 list, the stocks as a whole, they've just been horrible performers. There's a thing known as the winner's curse out there. So what you'll see is the IBD 50 list. They'll basically talk about the stocks that did succeed, that do run, and they continue to run and run. They focus on that. Done at multiple places, especially online. What is not discussed are all the stocks that had false breakouts, okay, and then what happened to them after they sold off and then eventually came off the list. So again, in looking at this ETF, and I'm going to show you the performance in a couple of minutes, it will give you a good way, at least in my opinion, to be able to offset long exposure, okay, to offset long exposure that you have in the AI stocks, that you have in the technology stocks, and I also use it to offset my market exposure. I like to hedge things. I like to have hedges in place, and I like to run a long short portfolio. It's very difficult, especially in the bull market, to have things on the short side. But I'll use FFTY. I've really begun aggressively to use FFTY to offset some of my long exposure. So we're going to look at the performance here in a second. But this is something that is really not discussed out there. They have it's a little bit under $1 billion in AUM, and something that goes back all the way back to 2015 when they first did this. So did a screen capture here at the time of this recording. This was as of Friday, Yeah, this was as of Friday. What was the end date? Yeah, the end date was June 21st. Friday, June 21st, 2024. And all you need to do is go to the bottom line there. If you can read this, I'll read it to you. Total return. So I compared it to QQQ, and the Qs during that period of time have returned 165%. They've grown 165% over the 5-year period of time. If you take a look at FFTY, the IBD 50, it's lost money. It's negative 15.74%, according to the readings that are over there. I have seen this continuously all the way through. People don't talk about it. It is, there are a lot, there's, and this is not meant as any disrespect. I know a number of very successful traders who use the IBD 50 and use the canceling methodology. They have their own ways to be able to do that. When the stocks break out, they'll end up doubling up in positions and going further. But when you take a look at it, basically this portfolio, which adjusts itself on a weekly basis, meaning within the ETF, you can see that it is far underperformed. The Qs, SPY, you can match it up against many indexes that are there. So if you're looking to offset some of your long exposure there in AI stocks, in technology, or in the overall market, this is something, again, one of the best kept secrets that are out there, better kept secrets that's out there, and I'm sharing it with you. You're likely hearing this for the first time. I'm sharing this with you. Do your homework in it, look in it further to be able to do this. But the data doesn't lie. The data is real. There's been tremendous underperformance in FFTY, in the IBD 50, versus the other indexes that are out there. Okay. And again, as I mentioned, it's not meant in any way as being disrespectful to many of the traders who swear by the methodology. I know I know a number of them, but again, I use it as a hedge against AI, long AI exposure, technology exposure, and overall market exposure. Use it as you see fit. Also, keep this in the back of your mind. We're in a bull market as I'm recording this here as I'm recording it here today. But when a bear market comes and as markets are turning over, use 200-day moving average or whatever you may define as a bear market, or if you believe even on a short-term basis that the market is likely to go down, this turns into an offensive weapon, meaning that basically, being short FFTY, there's also options in place to be able to do this. Take a look at its performance, or I should say lack of performance in 2022. Great place to be short. That's there. So again, new research, or not new research, I've known about this since 2001. But this is the first time that I've put it out there. I've placed it out there. And especially if you're looking to hedge, I've now provided you with a couple of opportunities to look at. You may have your own other hedging techniques that are there, but these are two of my favorite. Okay. One note on hedging, and this is what hedging is all about. Any type of hedging will often lower the returns, especially in a straight up bull market. So it's really there to smooth returns and ideally provide some protection on a market pullback. The percentage that you're going to use on the short side, meaning on, as far as your hedging exposure that you apply, it's very much a personal decision and is up to you. Okay. People use different type of hedging techniques and different percentages that are there. The one thing I would say is try to stay consistent with it. And try to stay consistent with it. In a bull market, there's usually less of a need for hedging, meaning the type of size that's there. In a bear market, if it's long exposure, it's going to be there. And no one rings a bell and says, okay, we're now, market's going to go up or it's going to go down. But that percentage that you use, do what you feel is best for you. Okay. All right. Let's go to the next one, which is number 7. So this one is important because with this emerging technology and AI, and again, this revolutionary technology, I stated this over a year ago. I stated it back in 2023. This is going to become the greatest technology breakthrough in the history, not only of our lifetime, but of mankind. I'm not the only person that has said that. great big names that, especially in the technology industry and science, scientists have said the exact same thing. So when it comes to shorting positions, what we want to be careful here. Number one, there is no doubt that AI is going to change nearly every industry out there. Okay, and many of the companies that are in these industries, many of them are going to make better, and others they're just going to obsolete the industries that are there. But things like this don't happen overnight. When new technologies come in, and as they move ahead, the stocks just don't automatically go just like this and just drop down. All right, it takes a while for that's there. Also, the companies, the industries that are eventually going to be obsoleted, and the companies that are eventually going to get hit by this, especially the companies, most publicly traded companies are run by very smart people. I've had the opportunity when I was with Merrill Lynch and Donaldson Loaf and Genrette. When I started my career, my primary customer base was made up of C-level executives in publicly traded companies, and I really got to know these individuals quite well. And they're very, very smart people. Okay, and very few companies go public unless it's done through bull markets or some sort of financial engineering. But it takes a lot for a company to go public, and it takes even more for a company to make lists like the S&P 500 list. Okay, so they're just not going to roll over. This is made up of highly competitive people who are very, very smart, and they know AI is out there, and they're going to go do their best to basically keep their companies keeping going. Okay, it's still very early in the revolution, and again, these businesses are not going to disappear overnight. So please be careful with the shorts that are there. I'm going to strongly suggest, and I put this in the weekly report, do not be shorting any of these stocks out there. There's open-ended risk when you short any stock. You could just keep going up and up and up. Puts are a much better play, and to be able to do this. The way I go about doing this with something like this is if a company announces that they're getting hurt by AI competition, that will usually come in during the quarterly earnings. Okay, I'll potentially list them as a short after the stock has been hit. So when they come out, and a number of them have come out over the past year and said, we're getting hit by AI, and this stock, it just goes like this. Usually announce the earnings after the close, and as soon as it gets announced, the stocks end up imploding. The safer play is not to try to pick tops in these type of things and do that. The better play on a longer term basis is let the company show their hand, let the company basically say, we're losing, losing market share to AI. Nearly every one of these companies, though, are going to come back and say, we have a way to be able to combat this. We have a way to basically make it better. Some do, many don't. But in the longer term, most of these companies are not going to be able to compete. And what I will do is share with you from time to time short suggestions that will be there. They'll usually have options in place. I'll probably not put up any suggestions that are there that don't have options. So options allow for fixed risk. That's there. But there can be a tremendous sum of money made on the short side, especially when these companies really come in. And combined with the fact that if they miss it during a time where the market is basically trending lower or there's higher volatility in the marketplace, they tend to go down and down and down. The momentum, I'll leave with this one final insight that's there. And I learned this over 30 years ago, and it's shown to be so prophetic, proven to be so prophetic. After a momentum stock gets hit hard from earnings and things transition, okay, and it starts transitioning to itself, it gets viewed as a value stock. So momentum stock is a value stock. It's usually dead money, which means that it's going to move sideways or it's going to move lower. It transitions away from all the momentum funds that are out there. It turns into value plays. It turns into value plays, and again, it's usually it's referred to as dead money, which means might be moving sideways. But in a bear market, they'll tend to just go lower and lower and lower. So not as a whole. There's going to be plenty of time to be able to take advantage of this. Hopefully we're together for a number of years as AI really just begins to take take off. And we want to take advantage of these opportunities on the short side when they do arise. Okay, number 8, the AI strategy framework that you likely saw in the webinar and that I'm going to keep in every weekly report is going to be built out methodically. As you saw, there's so many industries that will be positively impacted by AI over the next 18 to 24 months. Opportunities are going to be immense, and they're going to last for years to come. Our strategic framework is going to guide us as this revolutionary, life-changing technology continues to grow and change the world. Having that framework in place and seeing the vastness of it, and then identifying companies in selective industries that are there, the best companies in selective industries, and the ones that basically they're benefiting the most from AI. That's the focus of the report, and we'll continue to build that out. We'll continue to build that out as we're moving ahead. Okay. Number 9 is psychology. And this is the tough part. This is even a tough part for me. It probably will never go away, but I like looking at my account during the day. I like looking at my account multiple times during the day. I've been doing this for now, many years and now many decades, and hope to be expect to be doing it until that last day on Earth that will occur somewhere, hopefully many decades to come. When we're not trading these stocks, okay, and by trading I mean we're not looking for things on a day-to-day basis. We're not looking to be day trading. We're not looking to be swing trading. There's a time and place for that. You could be doing that on your own. The report itself is there to be looking at positions on a longer term basis. So the best suggestion that I could give, and even heed for myself, is do your best to pay little attention to the day-to-day movements, especially in the longer term positions. Okay. And those day-to-day movements can work 2 ways. On days where they pull back, no fun. It's never fun when they pull back. On days where they have these outsides move to the outside, to the upside as they continue to run, that's very, very exciting. But we don't want to get wrapped up in this day-to-day. What we're looking to do is we want to be disciplined. We want to be structured. We want to go about and saying, okay, we have a strategy plan in place. We're risking 1 unit in order, with the goal to make multiple units over a sustained period of time. What happens on a day-to-day basis is somewhat irrelevant as to what will happen over the next 18 to 20 months as AI just basically blankets the world. Okay. So again, this is very much up to you. There's going to be how you go about doing this. There is no doubt that there's going to be highs and lows on this journey. This is how revolutionary technologies play themselves out. Okay. And again, if you apply the concept of asymmetrical trading, ideally the wins that generate multiple units of returns will far offset the 1 unit losses, especially over the long term. So do your best. Again, I know we're all traders. Do your best to basically try to pay little attention to the day-to-day basis, on a day-to-day basis. Look at the bigger picture. Look 18 to 24 months out. Okay. Number 10. This just ties into it on an administrative side, because there is already so many subscribers, and it's going to build. I can see it. It's going to build to be large. I'm not going to be able to answer any trading related emails that are there. If I see certain themes come in along the way, what I will do is I'll address them in the weekly audio that I do. I'll also address them in the upcoming report, and I may even just address it here in the trading guidelines. So I'll just enhance I'll update the trading guidelines and give you the update that's there. But again, I'm not going to be able to answer any trading related emails, just simply because there will just be too many that will be coming in. If you do have any type of subscription questions, anything tied into, anything tied that is non-trading, some of you have already interacted with Darlene Davis. She's great. She gets to things immediately. That's there. Please email her directly. It's darlene@cg3.com, and she's there to assist you with those items. Number 11, there will be changes in AI along the way. It happens almost on a daily basis. I think everyone out there that has their finger on the pulse is very much seeing this, that every day something new. There are deals getting done, there's partnerships getting done, the technology is being advanced. It's very, very exciting. Okay. If I see anything that significantly changes both in AI and also on market conditions, what I'll do there is I'll likely do a live webinar to discuss it and to answer any of your questions. Okay. And this may be as early as earnings season, or earnings happen on a quarterly basis. If I see some sort of changes, and the changes could be good, they could be not so good, but any changes that occur out there that I think will have a significant impact on the long-term aspects and the opportunities that are out there. What I'm going to do is I will hold a live webinar. It will be recorded. My office will email you a few days ahead of these private events. It is only going to be for subscribers of this report. It will not be given on an outside basis, or it's only there just for us. So again, if I see any major changes out there, you'll hear from me. Otherwise, it'll be business as usual, and it'll be covered. I'll cover any of the things that I see along the way on a weekly basis. That will be included as part, especially in the audio portion of the report. Number 12, with options. For those of you who are trading options, what I like doing and what you likely have already seen it in the report, time horizon diversification will sometimes be used. What this means is that multiple expiration timeframes will be suggested on one stock. So, for example, I may suggest a stock with options where I'm suggesting 3-month options and also suggesting 12-month options. That's just a hypothetical. So looking at something on a shorter term basis and then looking something a portion of it on a longer term basis. We never know, no one knows when these stocks are going to go on a run, when any of these individual companies are going to go on a run. And the goal is essentially to be there. I do want to point out, and this is why I underlined it, this does not mean a double position. It means time horizon diversification, which comes out to be, it's a half a unit per position in one date and a half a position in the other dated position that's there. Going back to the example that I gave there, if you see something that has options, and I'm suggesting that's 3 months out and also 12 months out, it means a half unit for both. You're going to predetermine what a half unit means for you. You'll take your dollar amount, half goes to one, half goes to the other. Also, inside the report, I point out that half unit, when I do the time horizon diversification, I do a reminder that half units are suggested. Go to number 13. There's a tremendous amount of collective brain power here. And this is really great. The customer base has been very fortunate. People have interacted with through the trading market side and through the other ways that I've interacted in the trading community. It's not only professionals in the trading community, but I've had the opportunity to meet a lot of very smart people, many industries, who have become customers and become customers for many, many years, and in some cases, many decades. There's a tremendous amount of collective brain power here. And if you see anything that you believe is of interest on the AI side, and not so much something that may be that would be something that's on a day-to-day basis that basically most of the world knows about. But if you see something that really you believe will have an impact, I strongly would appreciate and suggest feel free to send it to me. AI is so vast, and so many of you have such great and broad multiple industry experience. I'd love for all of us to learn together. Okay. There's an email address here to send it to. Send your ideas and thoughts to me, not individual stock picks, but really just as an industry basis, or if there's a company that might be out there that may be of interest that's not in the broad-based companies that are usually mentioned here. Feel free to send them to AI Trading at tradingmarkets.com when you do come across something like that. And what I've seen over decades of experience is the more you share, the more you get back. That's the way it works. So the more we can all go about learning from each other, that's just great. And again, the more you share, the more you get back. And it's greatly appreciated. And again, very much respect the insight from the subscribers from all of you that are here. Good. Then for number 14, I'm going to wrap up on this. Enjoy the ride because this is going to be a lot of fun. There's going to be ups, there's going to be downs. But this is what I consider to be a once in a lifetime opportunity to participate in a world historical life-changing technology. It's an exciting time to be trading, and I strongly believe we're very early to the game, to the AI game. Even though these stocks have had pretty good moves there, no matter when you're coming on. They've already had pretty good moves. This is still just the very beginning of the emerging technology. And as you get to know the industry better, and as you go through the reports better, and as you get to learn over there, it's an exciting time to have the opportunity to be able to do this. And it's going to be, it's very much enjoy the ride there along the way. It's just really great to be there. So I want to thank you again for being a member of the AI Wealth Creation Traders Report. And if there is anything that I can do to assist you along the way, just let me know. Again, I can't answer any won't be able to answer any trading questions. But ideally, what we're going to do is we're going to continue to just grow and grow. We'll be together on a weekly basis. You'll get my report and audio. I'll do the special reports there along the way when we're live. And we'll just continue to watch this brand new, tremendous technology just change all of our lives, and ideally for the better. So again, thank you again for being a subscriber, and I look forward to being with you for the next year. So thank you again now, and have a great day. Bye now.